Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
It's time now for Your Money on News Radio 570 WKBN, and we're going to talk with Leo Daprile from Gem Young Wealth Advisors, a family business that does business with individuals and families that need comprehensive risk management for the wealth and assets that they believe the clients want professional advice, a fair value, and they deliver that by leveraging their reputation of professionalism, integrity, teamwork, and a get-it-done-right attitude. And they believe in making a difference in their clients' lives. And I had the pleasure of sitting in with one of their clients, Clark Capital, last week, just to see how everything is done. And it's done very professionally, and they can turn on a dime as new information is garnered, and they just don't stand pat. They try to manage your money the best they can. Leo, how are you this morning?
Good, Dan. Good morning.
Listen, we're going to talk a little bit today about the younger folks out there and that demographic that's elusive. In fact, we were talking about them last night in our post-golf interview. We were talking about some of these people out there, they don't pay attention to much. And you're highlighting today that age 18 to 34, they show a steep drop in financial literacy. Boy.
Yeah,
so
I found that very concerning, Dan, because the generations before, even if the basics were taught about the need to save and the need to investment, I think part of the challenge the younger generation has is there's just so much information out there and so much information overload they have out there that the financial literacy and the financial information, that isn't rising above all the other noise that's going on in their life. And I worry what this will look like for them 30 years from now.
So some of them could just sit it out. And that brings me to a point that I discussed this last Friday, that there's a move afoot to automatically enroll young people in the 401k, because most of them, they don't want any money coming out of their check. But if you have a firm that is, say, taking 3 or 4 or 5% and saving it for them anyway, there would be an automatic enrollment for a 401k. I kind of like that idea because it transfers with them, it follows them, and it gets them started, doesn't it?
As you know, Dan, we do a lot of work in the 401k space. And that's something, when we started having those conversations with our clients 3 or 4 years ago for automatic enrollment, there was a big pushback to having that feature. But I would tell you today, about half of our plans have the automatic enrollment because employers are starting to see, it's almost a corporate responsibility. It's how many of them are beginning to look at it to help the younger people get started with their savings. So it's an automatic enrollment in the plans we have, with the option for the individual to opt out, which we're finding it's a much higher success rate with the automatic enrollment going in, because when they're starting the job, they're not really sure what their net paycheck is yet. So it's easier to just miss that money immediately because they've never had it to start with. And that's the conversation we have around it. So start saving before you get the money, because you know how the average person is. Once you know what your paycheck is, most people will spend to what their paycheck is. So it's very difficult once somebody gets used to spending their paycheck to go back in and start making a meaningful 401k contribution, because they're used to living on that money. So we're finding it to be highly effective. As a planner, I've been pushing for that with my clients. Just number one, it's easier for the clients to administer, because if you don't have it, you're having to try to track these people down. If they're not interested, it's a lot of extra work. So it's a lot cleaner enrollment for the companies. It's better for the employees.
And the employers are sometimes putting in 5-10%, so it's really not coming out of the prospective employee's paycheck, is it? Because this is something that is a contribution from the employer in some cases.
And it goes back to a conversation that I've always had, and I've always believed this, and it's an old term, but it's timeless advice in terms of you should be paying yourself first. You're the one that worked for the money. You're the one that should be making sure that you have a comfortable retirement down the road, or you have financial freedom and financial flexibility down the road. So we've always worked to change what the philosophy of savings is for people. You know, no matter what you make, at some point in time, you're going to want to retire. So even if you only save a little bit, you know, that's still positioning you to have the choices you want later in life. And the reason I wanted to bring this up between the 18 and 34-year-olds, so if your parents out there with kids to the 18 and 34-year-olds, here's the message, and I pounded this into my kids' heads growing up. The decisions you make to save in your 20s determines how comfortable your 50s are.
Very nice. Okay, so we go from there. Let's look at the older folks out there. Do they have a senior? Do they have a superior knowledge? What's the story there?
Not necessarily, and there's sort of a fallacy there. And this is the old story, Dan, that what got you there, what got you to retirement, and the strategies that got you to retirement might not be the strategies that get you through retirement. And that's a lot of philosophical change, and I've been doing that a lot with my clients lately. In fact, we've even had this conversation that, you know, as much as people want to be conservative, the price right now to be conservative is so great, you might be short-circuiting your retirement. And the way I think, I don't think age 62 retirement. I think what's your life going to be like in your 80s and 90s if we didn't get it right today? So that requires a different way of thinking. So you may have been successful, especially not you necessarily, but the people that have been successful in saving, they enjoyed periods of time where there was high interest rates. So they were able to invest in CDs that paid them a nice sum of money. So they were able to be conservative savers and accumulate a fair amount of wealth. Well, in today's world, everything that got them to that point isn't working right now in retirement. So they're putting themselves at a greater risk of running out of money because the world's changing on them, and a lot of them are not making that, they're not adapting to those changes as quickly as they should and embracing a different way of managing their money, because if you're in your 90s and you haven't done it right, you don't have the mental capacity you did when you were 65, and you're having to make a lot more difficult decisions that you might not have the intellectual capacity to make anymore.
All right, so you say the literacy isn't that strong in later ages either. Does that have anything to do, does that impact Social Security on when people take it?
But one of the concerns, and we do this, and this is part of our planning process, is we do, as you know, a lot of what if projections. What if I took Social Security at 62? What if I took it at 66? What's the impact on my life? What's my plan? Because the rule of thumb is, you know, if you're taking it younger, especially in today's world, the difference between 66 and 62, it's a pretty significant haircut to what your Social Security check is. And now that you've locked that in, and in today's world where we've had low inflation and we've had higher medical costs, in many of those cases, even though you've been getting a cost of living on your Social Security, you've been giving it back on the Medicare side. So your net paycheck hasn't really changed much, but your purchasing power continues to erode. The problem is a lot of people think, okay, I'm 62, between Social Security and some of my other savings, I can have enough money to live on today. But they haven't really run that out to maybe a 30-year projection to say, was it really the best decision for me?
Right.
And that's the broader picture people should be looking at.
And people may not know it, but Social Security, they really give you a premium for waiting. The last I looked, it was about 8% per year up till age of 70. So every year you wait, and correct me if I'm wrong, you gain another 8% in your annual premium and for your annual check.
That's correct. It's actually 8.25%. Yep.
Okay. So that's a nice thing, because it goes back to what we had talked about before. If you're sitting on the sidelines and where you had the certificates of deposit where you could kind of count on that, they're just not paying anything, which leads me to another question. I see that there's a lot of publicity for investing in precious metals. If there's someone out there, you know, that formerly put their money that they were using for their 6 months' money in certificates of deposit, should they now put them in gold?
Precious metals are commodities. And the official answer is commodities can have a place in your portfolio, because commodities, and a lot of times, will, act independently of maybe stock or bond markets. So as a hedge against market corrections, commodities have their place, but a concentration into any one of those commodities, I don't recommend. I never did. It's like having a concentration in one stock. You have the same risk. You're betting too much on that. And if you're going to get into the commodities game, Dan, that's a whole different game. You got to know what's going on. And I wouldn't pay just attention to the advertisements, because I listen to a lot of these advertisements for a lot of these precious metals. And their selling point is trying to scare people into buying that asset class. And you should never think that way when it comes to an asset class. It should be something that makes sense. It should be something that has a future to it, not something that you're trying to just because you're afraid of it. And if you want to get into commodities, in my opinion, you want to get into publicly traded commodities. There's plenty of ways to get into that market where you can get diversity and liquidity, which is the key. Just like with what's going on in the bond market. It's, pricing has to do with the future of interest rates. Pricing has to do with inventory. Pricing has to do with liquidity. So there's a lot of moving parts in every transaction, be it a commodity or a bond, that if you're not proficient with, like I say the same thing. If you don't know how to play craps, don't go to the table.
Yeah,
right.
A lot of our seniors get caught up in the risk-free ways of earning income, certificates of deposit. Is there anything out there that is risk-free right now, or relatively so?
That's a great question, Dan, and I would like to answer that this way by saying nothing is risk-free. It's what degree of risk are you willing to take? And the problem with a lot of seniors today is the low-risk investments are the ones that are of the biggest threat to them right now. I was just reading this morning an article in the Wall Street Journal that said high-grade corporate bonds. Okay, this is what everybody wants other than government bonds, because that's the next tier down in quality. Their average return year-to-date is a minus 5.3%. Because people are selling out of their bonds because interest rates are so low, their yields aren't there, and they're looking at, now that these viruses are coming out, they're looking at a booming potential economy, which means a bigger lift in stocks. They're looking at a potential 6% CPI increase. So they're selling out of bonds. So people that are trying to be conservative are getting kicked in the shins right now with their bond prices. And if you own individual bonds and don't intend on selling them, then that's another story. But if you're in a bond fund, or if you're trying to play this out for income, you're kind of in a pretty heavy storm right now. And a lot of people didn't see that coming. That's why I wanted to bring that part of the story up to say, even if you're a conservative investor, look at what's happening to the really good stuff, because the economics of owning that are working against you right now. So that's back to the argument of why diversity matters, why you have to think differently than what got you here, because you got to make sure how you're set up today will get you through the next 30 years. And what got you to today may not be that strategy.
What about taking a portion of your assets and putting them into utilities? Because we're always going to have those. We're going to need those.
Well, in the old days, that used to be an appealing option, because you could just sit there and say, and the argument used to be, and I'll go back a time ago, we used to put clients that wanted income into utility mutual funds, because utilities always paid a nice dividend. They were relatively stable in price. But in today's world, the way utilities work are not the utilities we knew 30 years ago. They're much more diversified in what they are as a company. There's much more business exposures than what they have now. So I don't think just having that clear line of thinking like we used to be able to afford to do is good today. It's like anything. You have to be careful. I think a different way, if somebody's looking at, instead of specific asset classes, Dan, I would look at it, and how I do look at it, is two things. Number one, I put a goal rate of return for a client's financial plan instead of worrying about what averages are going to do. We need to know what level that portfolio needs to perform at so that the client can meet their objectives. Once we establish that, then we go back and build the portfolio to achieve that. Because if we have a client that needs, let's say, a 4% rate of return, then we know we don't have to have a super risky portfolio. But what we're looking for is we're looking for total return. And total return is defined as...
What I'm hearing, if you've got some cash on the sidelines, don't feel too bad about it, because nobody is making money with cash on the sidelines. But if you need the liquidity over the next couple of years, you may just want to keep that cash for right now. There's not a lot of short-term ways that you can make 2, 3, 4, 5%. It's just hard to do right now with that kind of money that you're going to need. Is that pretty much the short of it?
That's the short of it.
All right, my friend. I got to run, but listen, if you need yourself an advisor, he's terrific. I tell you what, they sit down, they have a fit meeting. I've gone through their process, and they've got Clark Capital behind them, and they are actively managing your money. They're not parking your money. Leo, tell us a little bit about what you do, and then I got to go.
Sure, all about the fit meeting, Dan. That's where we start. Let's get to know each other. If you want to call me and set up a fit meeting, you could call me at 330-533-6936, or you can email me at leo@gemyoung.com.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.